All right, good morning. It's 6:31 on Wall Street, 3 hours before the open of trading. It's time to get your global macro on. Let's do our QuantBox live and uncover the best fundamental opportunities for trading and investing across these global markets. QuantBox looks at sentiment, inflation, employment, GDP, technical analysis, open trade positioning through the commitment of traders reports, seasonality through 20 years of candlestick data research. So much more. Looks at gold and oil and yields and VIX and all this stuff. And it pulls it all together from all government agencies from around the world, like the Fed, the OECD, a whole bunch more. And it organizes it so that you can make intelligent investment decisions. Very cool. Just think of it as instead of hiring a quant to work for you, you just automate it and have AI do it for you. Yeah, cheaper. You can pay a quant 25 grand a month, where you can do QuantBox Pro for $800 a year. Love automation, because what it does is it takes you from retail trading, and now you can trade much more like an institutional trader. So anyways, hey, if you're watching this on YouTube, you're watching it many, many hours late. Why don't you take the trial? Visit quantbox.co. Join us live. You can be here right now, not hours and hours late, but now, right before, well, again, this is London lunch, so 3 hours before trading on Wall Street. So anywho, swing on by quantbox.co. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Oh, is that still there? Oh, that's interesting. Well, I got to get rid of that. I'll try to put that on my to-do list. All right, let's log into the QB Pro. QB Pro. All right, yields are up again. What? Yields are up again. 4.85. What? Oh, it was so good that dropped to 4.55. Now we're back to 4.85 on our way to 5.0. Well, with things like smoking red hot retail sales, well, the economy is not cooled off yet. So the world is trying to say, oh my God, maybe the Fed will raise one more time. So funny. So if you have a pro subscription, you can just go to the central bank tab, click on the United States of America, and you say, yeah, we already know. We already know. We've known for a long time. So while the market freaks out, they're one and done. No, they're none and done. No, they're one and done. No, they're none and done. No, they're one and done. You're just like, look, we've had this priced in forever that there's one more cut. Or I mean, one more raise, and then a pause, and then a pause, and then a cut. Also, what can we read into this? Oh, there's going to be a recession early next year. So the Fed will cut interest rates to support the economy again. Oh, yeah, but we already know this. Get? Oh, this one? Yeah, it's not active because what I did is I pulled everything that was underneath it back out because I tried to organize things and I organized it so well that I couldn't find anything. So I said, I'll do what my kids do. Just leave everything on the floor so you can find anything you want. instantly. Yeah. Isn't right? Yeah. So, yeah. So anyway, I should probably just delete that. Yeah, cool. So, anywho, we've known this for a while. Very nice. And the markets are going back and forth, freaking out, reacting and overreacting to the news, and must be terribly exciting for them. I don't like excitement. I like consistent. So, anyways, there you go. We get this data from the OECD, the Organization of Economic Cooperation and Development. It's a government agency, not a US government. I don't know who runs it. It's just an institution. Um, and they get this data from the Fed. Cool. But the Fed doesn't have all the information for all the different countries. So this is a good way to get it. So what's Australia going to do with interest rates? Oh, well, we already know that too. It's good to know these things when you're trying to plan your trades in advance. Huh? That's what I mean. Like you're not retail. You don't watch news and or react to news or freak out when news comes out. Institutional investor has this all planned out based on research and analysis. And so even though you're probably a one person show, I want you to be able to trade like you're $1 billion hedge fund. Okay. This is your Bloomberg, except it's not $1,000 a month. Anyways, oil's way up, gold is way up. And if you recall, now what, a week and a half ago, Sunday, well, I guess that wasn't here. That was the day trading group. So it would have been the Monday of the Monday after the Hamas attack on Israel. I made it very clear gold and oil are the big ones you want to look at. Dollar usually gets strong, although it really hasn't. And Swiss usually gets strong. And yeah, yeah, yep, 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 that happened. It very much happened. Okay. We're definitely tilting the risk off again. It makes sense. It's geopolitical risk. Okay. And like most government officials, they think politically and they believe, I think, they're doing the right thing and they end up making it worse. So Biden has flown out there to Israel. I suppose he was to bring peace. So now things have escalated and got worse, and all his meetings outside of Israel. So he was supposed to meet with big players like Egypt and the King of Jordan. These are big players that can keep calmness in the region, particularly the Arab world. Not Iran, but Iran's a separate thing, right? So all those meetings are canceled. So now the president of the United States is just kind of standing around like, uh, yeah. So, but a whole bunch more people are dead because you have to do something when the whole world is watching. Somebody was going to do something bad, and it's weird. I almost blame it like that trip has already cost people their lives, and it certainly hasn't fixed anything. So interesting. That wasn't the right move. So all I can tell you, if you study game theory, it's just not the right move. So, anyways, yeah. So I don't know what Biden's going to be doing the rest of the day. But when he's sitting there only hanging out with Israel, how do you think the rest of the Arab world looks at it? Like, is the United States really there for peace and humanitarian aid? That's not how the rest of the region is going to look at it. So, anyways, so there goes our diplomacy. Anywho, so risk off, risk off, risk off is definitely a tone. Things have gotten worse. And if you don't know, overnight, a hospital got blown up. And if you can think of what a Palestinian hospital looks like, unbelievably overcrowded, shoulder to shoulder people in all the hallways, got blown up. The whole thing's gone. Minimum 500 people, men, women, children, gone. So it's a diplomatic nightmare. So, yeah, that's okay. I didn't want to go there. I didn't want to go there. Oh, I want to go to scatter plot. All right, so many of the stock markets are down right now. FTSE way down. Well, I shouldn't overdo it. Down 0.5%. Nasdaq down 0.5%. DAX down 0.5%. Certainly not good. This outcome isn't good. Bitcoin is down, and of course, the bigger movers. Let's take crypto out. Let's let's just maybe look at getting rid of everything. Let's do it that way. Oil definitely up. Okay. Remember, that was game on from the beginning, from the very moment we got this geopolitical risk. Gold and oil was the big, like, focus on it. Focus, remember? Focus. This is where it's going to be. Now, oil was great because what it's done is it dropped, it gapped up, it double bottomed, it made it a higher high, came down, and now it's done this. It's just like a perfect setup. At Investor Boot Camp, we have a secret word. We call that hammock. And it's an old story, and I don't want to do the whole story. But nonetheless, very, very predictable. Perfect, perfectly predictable. And so now we're up here. So that's what's happened on oil. Gold just took off, never look back. Okay. So anyway, so my concern today, my focus today is this. Okay. Yields on the 10-year T note went from 4 point, I'm going to say 6. I think it dropped to 4.55, but 4.6, and now yields have jumped to 4.8, 4.85, is that right? 4.85. It's astounding. Which means the bond market, so bonds, it's really treasuries, but government bonds. Bond prices have fallen. Nobody wants to buy these bonds. Well, this one's a tricky one to interpret. Um, the bond prices dropped from 4.8 to 4.55 because of the geopolitical risk. Might as well go to safety. Okay. Um, and now, so why are they not buying it now? Well, because I mean, okay, so you could interpret this many ways, right? Okay, maybe the geopolitical tensions in the Middle East have uh, diminished. Does anybody think that? Yeah, it doesn't seem like. So then, what would make this happen? The market now is determined based on, like, retail sales, for example, CPI, PPI. All these things start adding up. Non-farm payrolls red hot. Remember that? It's starting to add up as of yesterday that the Fed's going to have to raise one more time. Boom, bond prices fall just like that. It's the only other way to interpret it. Or you think peace has been achieved in the Middle East. Thank you, Uncle Biden or Grandpa Biden. Grandpa Joe. Okay. Yeah, no. So now, and this is dramatic, by the way. You're like, but Wayne, it was 4.6 and now it's 4.85. It's I would imagine that's equivalent of a Euro USD moving 350 pips in a day. How often do you see that? Like, let me think about it. Never. Right? You're like, dude, that's a massive day. That's 3 times a normal euro dollar day. Uh-huh. So that's what happened in the bond market yesterday. So now yields are quite high and probably now on the way to 5, right? 5 here. Now, I think it gets interesting soon. If I may have a sidebar here. So, shh, everybody over here. Let's have a sidebar. You want to making the money? Yeah, we all want to making the money. At some point soon, there's possibly a bottom. Because remember, if this is going up, then bond prices are falling. At some point, according to QuantBox's information that we're pulling from the OECD, who is pulling from the FED, okay, we have an outlook based on what the Fed is thinking. Okay, the Fed's analysis. And the Fed is telling us there's a recession next year. And by the end of the year, they'll be cutting. So are you thinking 10 hours in advance or 10 years in advance? Well, sometimes we got to think 10 years in advance. So we got this 10-year T note that's going to go up and tickle the 5 area, right? Yeah, but according to what we believe is true now, we meaning the Fed, who actually controls all of this stuff, that they're going to raise one more time and then be done, and then within 1 year, cut. So if you buy a 10-year bond at an extremely low price that pays 5, as soon as the market believes the Fed is going to cut, you don't even need the Fed to cut, but especially, how about that? Especially when the Fed starts cutting interest rates back down to like 3.5, the value of this bond will skyrocket. It's going to do the opposite of what you see of prices falling and yields skyrocketing. No, when the Fed starts cutting, the yield on the 10-year note will drop. And so imagine, let's say, the yield on the 10-year T note 2 years from now. The new, fresh cut, brand new 10-year T note pays 3.5, and yours pays 5.2, 5.1. It's worth more because you have higher cash flows. For 10 years, you will earn a higher yield than everybody else, but you could always, whenever you want, sell the bond for more money than you paid for it. Whenever you want. Not a problem. People would be lined up across the street to buy your 5.1 yield when everyone else is now, the yield on the street is 3.5. You see? And so right now, there's a lot of money moving into money markets. It's actually becoming a problem. I know this because it's in the Fed meeting minutes and it's in the RBA meeting minutes, right? Who else said it? Was it, I think Lagarde said it in the speech. There was one other place. Does anyone remember from Investor Boot Camp yesterday? We saw it multiple places, the shadow banking issue. Well, at some point, when the Fed starts cutting, the yield on the 10-year is going to drop exponentially. As fast as it went up, it is just going to collapse. Where's all that money going to go? Everybody wants your 5.1% yield. The value of your 10-year T note would likely skyrocket as the 2-year drops to 2.5 from 5.5. You see, the money will need to go somewhere. So I don't know. And then you can just sit on that for 10 years. I don't know. At least it'll be paying higher than inflation, hopefully. Can you imagine, though, 3 years from now, we have 7% inflation? Oh, that would just be terrible. In that case, you might as well move to London. Okay. Anyways, so there's our little thought for the day. This will get interesting. So yields spiked to 4.5 because the rest of the world finally thinks the Fed will raise one more time. And again, because you are a subscriber to QuantBox Pro, you've known this for months. There's the hike. Okay. From here to here. Okay. So this is the mean, if you will. 5.35. One more hike to 5.43, 5.43, 5.43, and the third quarter of 2024, we drop it to 5.18. The fourth quarter, so 1 year from now, it drops back down to 5.0. And then we continue that trend down, down, down. So what has to happen between now and the third quarter? A recession. Cool. See, you already know these things. You can watch all the people on TV debate about it. And I would just say, well, according to the Federal Reserve and the Open Market Committee, who dictates these things, based on all the analysis of the economic staff at the Federal Reserve banking system, I know. I don't think. I don't have an opinion. I know. I know what the Fed is thinking. I know what the Fed is telling us. And I base my investment philosophy based on the facts. The thing is, I also know that for New Zealand. Okay. And so you see, maybe you don't like lines, you like bars. I like bars too. Um, Boom. New Zealand is likely to cut hard and fast, not just hard, fast, hardest and fastest in the future. Why? An opinion? Wayne, how do you come to that conclusion? I didn't come to that conclusion. The Reserve Bank of New Zealand has come to that conclusion. And they've told us the thing is 99.9% of the world doesn't listen to the Reserve Bank of New Zealand, not even Kiwis. But if you're a quant boxer, you know this to be fact. You now pay attention to what all the central banks are doing. You just don't have to read the reports. You just have to look at QuantBox. So nice. So that might be something you're very bearish in next year, huh? Okay. Huh? Isn't that nice? So you can extrapolate and say, well, they don't feel very good about global trade. This might be your play on China, huh? Anyways, so it's nice to be informed. Okay. You're not just good looking and witty with charisma. You're also pretty smart. Okay. Yeah. Because you're well informed. All right. So, anyways, we do still have geopolitical risk. The Biden trip to the Middle East, I thought was a mistake yesterday, and now it's a disaster. So I'm very concerned about the stock market because I want it to go up. Look, I want my money to go up in value, not down. Um, but we are now vulnerable because that was pretty bad news, and the geopolitical risk now is even more likely to spread like wildfire. Okay. Because remember the narrative. So Biden called Hamas and the Palestinian people the other team. What does that do to all the diplomats trying to bring peace between the two parties and solve this through diplomacy? To call them the other team? Well, like it's a game, but also like, I mean, that is such a casual way of speaking, first of all, to be the leader of the free world. But you should identify the subject. I mean, when you're writing, Harvard taught me how to write. You never say they, it. You always identify the subject matter, so it's clear. So, are you talking about Hamas? Or are you talking about the Palestinian people? Wait, are the Palestinian people the problem, or is it just Hamas, or is it all Arabs? Like, who's the other team? But it's undefined, right? But it's so casually out there. But in diplomacy, it's about bringing people together. So now what he said was us versus them. They're on the other scene. Like, it's not bridging, it's pushing apart, right? So anyways, it just blows my mind. And so now he's just told the rest of the world it's Israel and America versus you. And I don't know. So how does that help? I don't know how that helps. So he's supposed to be meeting with the king of Jordan, who, by the way, just out of history, it's a place to meet through and get backdoor channels for diplomacy. This is how Jordan usually plays into things. It's territory. It's sort of the Middle Eastern Switzerland, if you will. And then Egypt. So the president of Egypt was going to be there too. So not just King Hussein, but also the leader of Egypt. Um, and I believe they were going to, Abbas was going to be there. So, anyways, there was a real chance for diplomacy here. That's what Biden was supposed to be doing. And of course, people want to stop that. In a time of war, you want to stop the opportunity for peace, right? So anyway, so he flew in, someone made sure that that wouldn't happen, and now diplomacy's out the window. And now Biden has set it up where there's no diplomacy, but it's also us, America and Israel, against them, the other team. You're like, so now it's a disaster, in my humble opinion. A real bad play. I bet you anything too, his own advisors were like, "Don't do it. Don't do it. Just let us work it out." Okay. So anyways. Um so that was a bad move. So now what? I think it's less likely. How about that? We have to talk in like probabilities. I think it's less likely this is going to go up now, and I need it to go up. So one concern I have is that I might need to adjust that the recession just started, right? We wanted this to be the period of rally. I said in January that the worst case scenario is that in October, something happens, we don't get the rally. And geopolitical risk, particular one that looks like it's going to get worse and worse and worse, that's the thing. That's the thing. And it's going to get complicated because and we're adding $300,000 or 300,000 jobs a month, right, on non-farm payrolls. We got consumer spending going up, 0.8% month over month. Like um, Americans we still have inflation, we still have spending, we still have jobs, and is this what tips us into recession? So I don't know. It's hard. This one's a toughie. But employment lags. Employment lags. You don't just lay people off because something you saw on the news. But I'll tell you an experience of a startup that I ran. Everything was good. Everything was great. By the way, Silicon Valley Bank was a sponsor of one of my companies, which is good. So I knew Silicon Valley Bank really well. Um, and everything was good. And I was bringing in money and I was doing stuff and I was being productive and contributing to GDP. And then, like, within, I think it was less than 90 days, the dot com bubble burst. I'm telling you, with that 90 days, like, I think it was less than that, 45 to 60 days, all income went away. It was just over. Not my business, all businesses. And it's hard to imagine, but that it's always in the back of my mind where you're like, but we're adding 300,000 jobs. But you know what? You don't know in 2 months if we're cutting 300,000. I don't know. I don't think so. So, but because this geopolitical risk is a real threat now, and I suspect it will now get worse. I can't see the way the cards have been played. I don't see suddenly somebody coming off the bench and scoring 50 points to win the game, right? Like, it feels like we've brought a losing game to the situation and it's only made things worse. So how do we suddenly get out of this situation with a positive outcome? I'm worried that that's now impossible, right? So now I have to then look at probabilities of downside that will take down whatever's going well in the US economy. This will take it down and adjust. And I basically have two fronts. I have massive geopolitical risk that's almost certainly going to get worse, but the US economy is doing all right. Which one's wrong? Has the recession just started now, or is it going to be in 6 months? So, anyways, that makes life complicated, but that's why you need good data, and that's what QuantBox does. But you also need a good team, and that's what we do. So I'll leave you to that. Watch the stock markets. I think that's going to be the judge. Also, on the flip side, like, what's good? I told you that I expected positive earnings this season because we had good GDP. So far, that seems to be the narrative. Bank of America has made more money last quarter than they have in over a decade. That smells like good to me, right? But we have Tesla and a whole bunch of others reporting today and soon. So probably more good news. So hopefully the good news overweighs the risk of geopolitical tensions, because right now it's tension. It's not global macroeconomic destruction. So maybe we're tensed on the over here, but then making money over there. I can live with that. And then we'll probably get the stock market decline in January. That's what I'm prepared for. I'd love October, November, December to be positive in the stock market, and then start next year on the downward move. I just don't want to start the slope to the downside now. Okay. So, anyways, peace on earth. May the pips be with you. May your profits be above average. I'll see you when I see you.